Hi, everyone. Thank you for joining us today. My name is Marche. I'm the webinar director here at Advice Chaser. Before we introduce our guests and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's situation. Advice Chaser regularly hosts informative webinars such as these, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you this educational presentation today. Attendees are muted, but we encourage you to ask questions using the chat box, and the presenters will answer those queries during or after the webinar today as appropriate. And if we don't have a chance to get to your question during the webinar today, go ahead and leave your phone number as well. We'll make sure someone reaches out to you after today's event. Once again, we want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to today's guests. Our moderator today is Derek Martin, and he's with 56 Capital Partners. He's a Michigan native and enjoyed working on his family's farms, cattle and grain on his father's side, and fruits and vegetables on his mother's side. With a bachelor's degree in finance and economics and health sciences from Kalamazoo College and an MBA with a specialization in corporate finance from Walden University, Derek worked with small blue-collar business owners to help manage their finances after working on the farm. Feeling the need to serve the country he loves, Derek earned the title U.S. Marine and served active duty in the Marines as an officer for 5 years. Derek is married, enjoys being a lifetime NRA member, and loves the beautiful outdoors of Colorado. And Derek, go ahead and say hello so we can see your face, and we're glad you're here.
Hello, everybody. Looking forward to helping moderate this event and answer all of your questions.
Great. Well, I'd love to introduce you to today's presenter. Don Beelan is a principal at Perkins & Company Accounting and is an expert in business transition and succession, consulting, and transaction advisory services. Don specializes in ownership transitions and business successions for successful business owners and affluent individuals. Since 1992, Don successfully completed in excess of 300 business transition and succession plans for clients throughout the United States. He works closely with Perkins client and staff to provide direction and consultation to design and implement advanced planning strategies. He is recognized by his clients and other advisors as a trusted, knowledgeable, and organized creative leader in his field and community. And Donna, I am ready to turn the time over to you. We're really excited for this content, and let's go ahead and get going.
Marce, thank you. Very exciting. Welcome, everybody. It is sincerely my pleasure to share some thoughts and information that I hope that you can apply to either your situation or either your clients. So I've had the pleasure of working with closely held businesses for, I even hate to admit it, well over 25 years. I was raised in a family business, so that gave me the start to understand what some of the family dynamics and some of the challenges and opportunities related to the transition of closely held businesses. So I'm very much looking forward to this opportunity to share my thoughts today. So in today's discussion, I'm going to focus around this concept of balancing personal and business financial requirements. But before I get to that, I want to talk about this concept of business transition planning and what it might mean to the marketplace. I think there's a lot of ambiguity in the marketplace as it relates to what is transition planning. There's words that we can't consistently hear. Some are like exit planning, some are succession planning, some are succession or transition planning. So just to draw a little distinction between those three elements, generally what I see exit planning meaning is organizations that help businesses prepare for a third-party sale. So taking it either purchased by a strategic or a financial buyer. Secondly, succession planning in our nomenclature refers primarily to operational succession and leadership transition. So they're more concerned with who is ultimately going to take on the reins of the business, control and operate, and also prepare for the long-term strategic vision for the business. The third area, transition planning, is primarily focused in our terms is looking at the transition of the ownership, but not neglecting to take into consideration the complexities related to the transition of the operations, the transfer of the operating control, then ultimately things that correlate with that are the family governance, which is really the family relationships, roles, responsibilities, but then also corporate governance in terms of preparing and monitoring financial performance, holding key executives responsible for specific results, and also planning for the long-term strategic positioning of the organization. So that is, just give you a little bit of backdrop in terms of what transition planning can be and what it might look like. So in today's discussion, and I'd like to make this as much of a discussion as possible, not necessarily a presentation, because your thoughts and your questions are going to be very valuable both to me but also to the other participants. So this slide here is just talking about what we're going to and outlining what we're going to touch on. So I'll start with talking through the agenda, so the major items that we're going to touch on. Part of that will include a complete description of the planning process. We'll talk about the importance of financial modeling, how you use personal financial forecasting, and how that dovetails with corporate financial forecasting. We'll have an opportunity to discuss a few specific strategies related to transition succession planning. I'll highlight the benefits related to that, then pull it all together in a summary. So it's just like when we go through the planning process, there's a lot of related elements. So in our discussion today, I'm going to touch on 4 elements and then try to drill down on each of them. One is I'm going to introduce a family that is actually a live family that we've just removed the confidential information and somewhat genericized it. We'll talk about what are their primary objectives and the drivers for the planning. We'll talk about the tools, the financial tools predominantly, and some of the estate tools, and then how that relates to the planning strategies.
Don, before you actually dive into that, we have our first question. So love the fact that we are already having discussion. Mary asked, you mentioned the balance between family and business there. She wants to know, is that why most business transition plans fail, is trying that balance, or is it something else that you see more often?
Well, yeah, Derek, I think that's a great question, and thanks for asking. First is the balance between family and business is by all means probably one of the most complex, because you have the difference between emotional considerations and related to relationships and financial considerations as it relates to value and financial security. So what I see is trying to create something that is non-tangible with something that is tangible, and interconnecting those is part of the complexity related to this process. But what I also heard is the underlying question is what are the major reasons why transitions fail? Well, number one that relates to what I just shared is, and it's been well noted, that about 70% of transitions fail from first to second generation for 2 primary reasons: breakdown of trust and communications. And because of that breakdown of trust and communications, that's where the relationships become stressed, the communications stop, trust is severely degraded, and the overall process kind of implodes, then it becomes a legal conflict. The second major reason is, in addition to the trust and communications, is just the competence, the ability for individuals to really assimilate the information necessary to competently construct a well-defined transition plan. and also get into a little bit more of those elements in our discussion today. Thank you. So let me introduce the Myers, and this is a family that I had the opportunity of working with for well over 10 years. And so there's the mom and dad. We have Marie and Danny, so not to be confused with Donnie and Marie, but Marie and Danny. Marie is 65, Danny's 70. They have been coached to share the ownership 50-50 between them, and they collectively own 100% of the company. Well, they own Myers Sporting Goods, which is primarily a manufacturer of sporting goods equipment. They also do have a retail operation, but their primary business is manufacturing, and then the retail business is a separate entity. They have 4 children, 4 beautiful children, Marty and Monica. They're active in the business. Marty is a sales manager, and Monica is a chief operating officer. Then you have Mary and Mark that have chosen their own professional careers in the marketplace and not involved in the business by their own choosing. In addition, they were well coached and advised that it's important to put the commercial real estate outside of the business. So the manufacturing facilities and some of the retail locations are owned in separate LLCs that are 100% owned by Maria and Danny. So the first step that we wanted to begin the education process, because working with business owners and their families, they're good at running and operating and building this business, but this is not where they spend their time. So it's relatively foreign. So I've found that it's very important to give them structure. So the first step is to look at the 3 key areas that they need to define in terms of what's important to them. You have personal objectives, business objectives, and family objectives. So as it relates to the personal objectives is helping, in this case, Maria and Danny understand how much value that they need to realize from what they've accumulated in the business and non-business operating assets. So what is their financial security requirement? Secondly, what are your goals in terms of when to transfer control to the next generation? And also, let's define your relationship. At what point and at what rate should Maria and Danny reduce their involvement in the business? But we look at it from a business standpoint is also, if you're going to transition this business, how would you like to fund the transition? Is it a gift? Well, in this particular case, they wanted to fund it as a sale because they wanted the children to have some skin in the game and be forced to, not lack of better words, to run and operate the business for their own benefit, but also to make sure that Marie and Danny realize the value that they need. Also, they wanted to make sure that the business remained strong. And finally, that was important that the business continued to grow and expand. You probably heard this before. If you're not growing, then your business is dying. So they've really adhered to that principle, and they believe that constant growth is important. Then looking at some of the emotional or kind of non-tangible considerations, and they look at the family. The family has been always very close, very Christian-based, and so unity and maintaining relationships during and following this process is of utmost importance. Also, they wanted to be fair and equitable. Well, I have constantly told clients, unfortunately, in this world, there's no such thing as fair, but there might be equitable. And equitable oftentimes is defined as the individual's contribution towards the asset and considering their role and relationship to the asset and doing something that is somewhat in line with the individual's ability to drive and build value. Then finally, they've accumulated a significant net worth. Their net worth is about $30 million. So they do have an estate tax consideration. Right now, the current limit is 11.7 per individual, and we'll get into this. But they want to preserve and protect the estate.
Don, while Marche is changing the slide there, Bill is asking, when should a business owner begin the process of planning, and why or what would be an indicator?
Yeah, great question. Back to, and this relates to why many business transitions fail, is lack of proactive planning. And so when we look at the transition of a business and the desire and when to start, it's most important to start roughly 3 to 5 years out from when you actually see the, lack of better words, transaction. Because transition planning by definition is a process. That's why it's called transition, not transaction. And so we like to start 3 to 5 years, number one, because we want to be proactive. We want to position the business so that it can be in a financial position to finance and fund an internal transition, which is the majority of the cases. Number two, we need to help business owners plan to diversify their assets. The mistake that I see many business owners make consistently is they believe that their best return is reinvesting the profits back into the business and growing it because that's been the best return on their equity. That is indeed correct, but what it does over an extended period of time, it increases their concentration on this one asset. And because of that concentration in the business as their primary asset, it limits the opportunities in the structures available for a transition. So by example, if an individual's personal net worth is 90% comprised of the business, then they're dependent upon the business, as opposed to, I like to see a mix of about 1/3 of the business, 1/3 of the net worth be the business, 1/3 be the commercial real estate, and then 1/3 be marketable securities, qualified and non-qualified. So when it comes time for the transition, then we have multiple assets to draw on for the financial security, and it gives us many more planning opportunities or structures available for a diversified asset base as opposed to concentrated. So a lot going on there. So let's jump into some of the financial analysis that are very instrumental in solving for a solution. As I've touched on with the Myers, financial security was of the utmost importance. So we needed to try to strike a balance between the financial security, how much value they need to realize from the business, and then also what the business can afford, and look at the differences there. So by example, let's say their financial security, the Myers, they need to receive about $10 million for their financial security based on roughly a 25-year time frame. But in the business, it really has limited liquidity and has a fair amount of bank debt. So how can we extract this $10 million from the business over this period of time while still funding its growth? So I'll go into more of the detail in terms of how we try to strike a balance between personal financial security and corporate financial requirements. So then it leads us to the beginning of, after we help inform and bring the client to the same spot that we need them to be in terms of understanding some of the dynamics, the goals, the tools, let's begin to explore strategies. And the strategies are designed to prepare the individuals for this transition, protect the assets, but also perpetuate the business and perpetuate the family's net worth. So in this process, we look at ownership transition structures. We'll discuss the trade-offs of each of these structures. Then we'll complete a financial analysis, both personal and corporate, and analyze their respective results under varying sets of assumptions. Then finally, we'll review strategies to protect the assets. Let's get into the nuts and bolts in the planning process. So the planning process with the Myers is we start by refining the Myers planning objectives. And the reason why I use the word refine is because the majority of individuals don't walk around with a defined set of objectives in their back pocket. The reason is that they are not had the opportunity to fully understand all of their options, and then the relative trade-offs in terms of the advantages and disadvantages of each option. So what we have found by identifying the applicable strategies, analyze those strategies and comparing and contrasting them, it gives the family an opportunity to basically choose from a menu of options as opposed to saying, what would you like to accomplish in your life and making it an essay. So we break it down into personal, business, and estate planning objectives. and create a defined set of objectives, because I think it was Mark Twain that said that you might as well plan for the future because that's where you're going to spend the rest of your life. So the second step in that process is to review the existing situation. So we have to understand what is currently in place, what planning has been completed, and what's outstanding, and where the opportunities and problems exist in their current situation. So we'll look at personal financial statement. We'll look at the family, discuss and even interview the family members. We'll look at the business, understanding its dynamics, its marketplace, its growth potential. We'll look at the estate. How would they like to distribute their assets? We have active and inactive children. How do we be fair and equitable amongst those children? What are the existing agreements? What do the shareholders agreements say? What do the operating agreements say? What do the redemption agreements say? Do they have a distribution policy? What do the bylaws say? When we look at corporate governance, all of that. We want to take a look at the insurance. What is their contingency plan? How much liquidity is available in the arrangement? And what does it mean in terms of an estate transfer standpoint? What is their tax situation? What's their historical tax situation look like? And what does the future situation? So it's important to get your hands around the current arrangement in detail. Number 3 is to quantify the personal financial requirements. I'll touch on that momentarily. Number 4, analyze the business financial results. It's the what ifs. Number 5, identify and test the planning strategies. We need to create a laundry list of applicable strategies that are going to that have potential application within this planning arrangement, and really eliminate the ones that are just non-starters. Then finally, once we go through that process, then we need to work with the advisor team, the attorney, the accountant, sometimes a business advisor, insurance, wealth manager, to execute the decisions. Then finally, we need to monitor the results because we're understanding family business and family situations are dynamic. So we need to continually update and fine tune the planning.
Don, I'll step in here. John asked some common objectives people tend to have, and I'm going to combine that question with Mary again. What if we're under the estate tax exclusion? I think that's kind of the combination question of what are some of those other objectives people might be chasing if they are under the estate tax exclusion. You give an example, maybe a personal or a business one?
Yeah, I think as we've touched on very briefly is the personal objectives may be related to their ongoing involvement. I think it's extremely important that we define that and put it out in writing in terms of what the mom and dad in this particular case, what their transition plan looks like in terms of how much longer, how many hours you're going to work in the business, what are your primary roles and responsibilities? How does that impact and correlate with the key employees? You might have objectives related to, as a business objective, how do you maintain and incentivize your key employees, considering that you might be stepping away from the business? As it relates to the estate, if you're under that exemption, that typically means that you might be more dependent upon that personal net worth, depending on your standard of living, to retain as much of that value personally. So how do you then retain the value, maybe from a cash flow standpoint, but transfer the excess value out of the estate? Right now, under the current law, at the end of 2025, the exemption goes from approximately $12 million per individual back to about $5 million, and that's indexed. And that's under the current law. It's even anticipated it could be lower. So it's important to understand that tax laws change, and we need to be very cognizant of what those laws are currently and then work within those confines, but also be anticipatory of future changes. Okay. So let's dive into the actual ownership transition process. So the key questions we need to define with the Myers is when I went to them and sat down and said, when and how to transition the ownership? What would you like to do? Would you like to gift it? Here's your gifting options. Or would you like to sell it, or a combination thereof? What is your timing? Should you get a small portion or sell a small portion now? Or would you like to make a large transition and make it a one-time event? So really trying to help them understand that we can mix and match the various timing with the structures to accommodate their ideal objectives. Secondly, maybe just backing up real quick, is then protecting assets. In this particular case, we have children that are either in their first marriage or soon to get married, is looking at should the assets being held in maybe trusts, should we look at maybe protective agreements, maybe it's a prenuptial, maybe it's a stock redemption agreement, those kind of things. And then I'll get into what we did for the Myers, actually what their transition strategy was.
Before you go on, Don, we are getting good participation here. So thank you for those. The chat window is at the bottom. If you move your mouse towards the bottom of the window, it'll pop up. You can click on that and it'll come to me. They were asking, since you mentioned trust, would that be a time or a technique that you would also think about gifting to a charity or including that in the plan?
Without question. If an individual has philanthropic objectives, and there's also a combination of some tax mitigation. So let's say you have a low basis asset that you anticipate a future liquidity event, having that being sold, but you also want to retain either an income stream for you or an income stream for your children. There's ways that you could structure like a charitable remainder annuity trust. A great tool, which is very popular right now, are called donor advice funds. They're called DAFs. Would strongly encourage an individual to explore the use of a DAF. Charitable remainder or unit trusts or lead trusts are also very popular for meeting a philanthropic objective. But a DAF I've seen is probably one of the most flexible vehicles in the marketplace today. So let's talk about some of the planning strategies. We touched on this and Derek alluded to it. And this may be overly simplistic, but like in Danny and Marie's situation, they have the ability to gift $15,000 per year. So one individual to four individuals can gift $60,000, and then times two is $120,000. So in one particular year, you could make annual exclusion gifts of $120,000 if you have four what we call targets. In addition to that, the current exemption is 11.7, and that's indexed. So it was 11.2 in 2019, and then it's been indexed up to 11.7. So you have the ability to transfer a significant amount of value out of your estate during your lifetime, but hopefully not to the exclusion of your financial security. Number two strategy, and this is almost a varying level of complexity. Secondly, we could take a look at what we call retained interest trusts. One common strategy that's in the marketplace is called the grantor retained annuity trust. So the benefit of using this trust is basically you can transfer the asset to the trust while retaining an income stream for a set period of time. And at the end of the term of the trust, the assets can drop down to the kids tax-free. So there's some calculations that occur, the difference between this value gifted in the trust minus the value that you retain. That's the amount of the actual taxable gift. So it's a very tax efficient structure. You could keep it as simple as looking at a corporate redemption. So with the Myers family, we wanted to take a look and say, well, does it make sense for just the corporation to buy mom and dad stock? In this particular case, it was very taxable and very tax inefficient. So what would happen is in this case, we modeled whether or not we could gift a small portion down to the two active children, have the company redeem Danny and Marie's stock and with a residual payment. The problem with this equation is that, number one, the sale of the redemption to the corporation is a taxable event. So Danny and Marie paid capital gains taxes, state and federal. Plus then the corporation as an S corporation, so it's a flow through, but it pays taxes. So we earn $100. We only have roughly $60 to pay mom and dad. So you pay taxes on the sale and you pay taxes on paying for the stock. So the double taxation makes it a challenging opportunity, even though this is a commonly used structure. In contrast, an individual could do a cross purchase. And what that means is rather than the corporation buying stock, individuals can buy stock from other individuals. So in this case, we looked at having Dan and Marie sell stock directly to their 2 active children. And fortunately, because of an S corporation, we can flow through it's a flow through entity, flow through the income down to the children. They could use those proceeds, pay tax, and then buy the stock for mom. The benefit of doing a cross purchase versus redemption is that the 2 active children have a much higher stock basis. So in the event that they sell the business downstream, their capital gains are considerably less. If we do a corporate redemption, the stock basis isn't increased and future tax liability could be much larger. The third strategy that we looked at is termed as a sale to a grantor trust, or you might have heard this term before, IDGT, IDGT. So this is a very popular strategy, and the primary benefit of using an IDGT is, number one, because it's a grantor trust, meaning the tax liabilities is retained by the grantor. So in this case, Danny and Marie, we can set up a trust. It's a trust they created. We could sell the stock to the trust without having a capital gain. And then all the money, all the earnings that are earned, attributed to the stock in that trust, 100% of that value can be used to pay mom and dad back. So in this particular case, it's an extremely tax efficient way, because if the corporation makes $100, we have $100 that can be used to apply towards the installment and expedite the payment of that note. So IDGT strategies are extremely effective. An alternate strategy that has been around for decades, literally, is the use of a private annuity. And basically, the advantage of a private annuity is that you can sell the stock to either a trust or to the children. The children structured as an annuity where mom and dad receive a set or scheduled payment until their death, is the way that could be structured. Mom and dad would pay capital gains on the sale of that stock, and then the payment would be a function of the earnings that flow through the entity into that trust. So private annuities do have their place and time in the planning process.
Don, before you go on, Aaron's asking kind of a 2-part question here, and it has to do with the private annuity, so you can provide a little clarification, because it's not like other annuities. She's heard about high commissions in annuities, so you'll tackle that. But then also, do low interest rates affect this? I know it can actually be beneficial right now. If you could tackle those, please.
Yeah, definitely. You're correct, Aaron, that there are high commissions generally related to sale of an annuity, because that is an insurance product that's issued by an insurance company generally. A private annuity doesn't involve a corporate entity at all. It involves just an agreement between a trust for children back to mom and dad. Regarding interest rates, the interest rate used to calculate a private annuity generally are going to be the applicable federal rate. It's called the IFR. And the IFR continues to be at historically low levels, which makes that trust a very efficient vehicle. So basically, that's it. So in addition to this planning strategies that we just reviewed, we also then brought into some related components that could come into play. Number one, I've touched on very briefly, is the concept of using an irrevocable trust. An irrevocable trust is basically a box that's created. You, in essence, can't make any changes to that trust once it's implemented, but it provides an opportunity to remove assets outside of the taxable estate. You can also use alternate capitalization structures like voting and non-voting. So in this particular case with the Myers, we restructured, being an S corporation, we can have voting and non-voting. It's not treated as 2 classes of stock, but the benefit is to bifurcate voting from non-voting equity. So we can transfer equity out of the estate or to the next generation shareholders without jeopardizing the remaining mom and dad's case, in this particular case, jeopardizing the ability to control the corporation. We looked at alternate capital structures in terms of how we do the capital stack, in terms of whether or not we use debt to fund it, whether or not it's a seller's note. Sometimes we'll use debt from an outside third party because we can take more money, basically put more money in mom and dad's pocket to reduce their overall risk, and transfer the risk to the entity. We look at separate entities, whether or not they're family limited partnerships or LLCs, to separate and create a distinction for liability protection purposes. Also, what I've seen, the last one, joint ventures, typically when I'm dealing with an organization that has large contingent liabilities, we might have issues, let's say a construction company, or maybe it's a medical practice, where there's contingent liabilities that may exist for decades. So sometimes we'll have old co and new co. So new co is the company that we build and expand the business in, and old co generally through or over time is just kind of wound down and closed down, and the new business takes over. So that's one of the very popular transfer techniques for companies that have liability considerations. So let's go into the specifics with the Myers ownership transition strategy. So what we decided to do with Danny and Maria is, with Monica and Mark, we used the IDGIT strategy. So we created an irrevocable trust. It's a grantor trust, again, meaning that the income tax liability remains with Danny and Maria, and we sell it to the trust. But before we do the sale, we gift about 10% of the value that we're ultimately going to be sold into the trust. That's basically what we call seed money or corpus. Then we sold 39% to Monica and Mark's trust. We did 39% because we wanted to layer this through time, because Monica and Mark, we didn't want to put too much debt into the equation. And we also want to make this kind of a stage transition, so we have some ability to make changes in the event that Monica and Mark don't perform and don't really coexist very well. What it also left us with Maria and Danny at the end owned 25.5% each. Of that 25%, part of it was voting interest, part of it was non-voting interest. But the other benefit, we created two minority interest blocks that then we can apply valuation discounts, probably between 30 to 40 some percent discount in terms of calculating their taxable estate. So we killed several birds with one stone. One, we made the transition. Number two, we retained the controlling interest. And number three, we reduced the taxable value of the estate. So the other key question, go ahead, Derek.
On that last slide there, Marche, Chad was asking, because you mentioned business valuations, when should that be completed? At the start of the process, middle, and are they expensive?
Great question. The mistake I see oftentimes made is the business owner believes to start the process, they should go out and hire a business valuation person. I've seen that cost be between $10,000 to $30,000. One key takeaway is that an individual must determine the purpose for the valuation, because the purpose for the valuation really drives what the valuation expert does in their overall process. So by example, if the purpose is to understand what the business is worth to a third-party purchaser, then the valuation person will look at and maybe weight the market element of the valuation, as opposed to if it's for gift and estate purposes, then they'll value probably a minority stake, never value the entire enterprise, but value a small block of stock for gift and estate tax purposes that can be used to file either your 709, which is your gift tax return, or 706, your estate tax return, and to meet the disclosure requirements for that. So my suggestion is that a business valuation should be completed prior to completing a gift, to know how many shares can be gifted, but not at the front end of the process. Okay. So key question, we're running a little long on time. I'll maybe abbreviate here, but one of the key questions when we're looking at this internal transition is trying to figure out how much can the company afford. So the way we answer that, we did corporate financial forecast. We need to understand revenues, potential growth rates, company cash flows. Also is how much of the company's earnings need to be reinvested into capital expenditures to fund and maybe create the foundation to build or to run and operate the business under a higher growth or revenue level. Or then how much could be distributed out, because in this case, Danny and Maria, because we structured this, we need to have distributions coming out to fund the installment. So it was a balancing act between how much do we distribute out to fund the buyout and how much we retain to fund the growth. On the second to last item is understanding the corporate value. We needed to understand how much that Danny and Marie need to realize from their ownership during their lifetime in terms of cash flow. Then how does that relate to the corporation's value as it relates to the estate transfer? Understanding there's different values for business ownership. So the structures, we've touched on these, so I won't revisit that. And just want to highlight the process with personal financial security analysis. Oftentimes there's software packages, Money Guide Pro or eMoney, et cetera. But with most family businesses, I find with multiple assets, multiple commercial real estate, retirement plans, personal and marketable security portfolio, there's a lot of dynamics that most software platforms don't analyze very well. So our process, we want to take a look at the personal net worth and figure out what is the core capital, which we call financial security requirement. And the difference between what you have and what you need is what we call planning opportunity. Then we back into that and determine what that core capital requirement is by using a Monte Carlo simulation. So we're working through multiple iterations to figure out how much value that the individuals need to receive from their ownership, considering other assets and other cash flows, real estate or qualified plan distributions, by example, and what that means in terms of satisfying the long-term financial security requirements. So this is just a more expanded detail of what that simulation output might look like. So at the conclusion of the process, we then looked at both corporate, in terms of determining answering key questions. How do we allocate cash flow, distributions or retention? What is the income of the company versus cash flow? Because we also sometimes have to pay attention to what's happened with our bank debt covenants. So if we're going to leverage the business and finance a portion through a third-party lender, then we need to make sure that the company is in compliance with those covenants on a year-to-year basis. Then also, if we're making larger distributions, what is the long-term impact on the value of the company? And if it's flattened, it's important that we understand that in managing expectations as far as the shareholders are concerned. On the personal side, we wanted to then continue to keep Maria and Danny's personal financial models updated so we know what their taxable income, what their tax liability, and then what their after-tax cash flows are annually. We're also monitoring their asset composition in terms of what's the makeup of the net worth in the business and the commercial real estate, then how much liquidity are we accumulating inside the estate to ultimately fund the estate tax liability and reduce their dependence on these business assets. So what I'm trying to do is make the business almost irrelevant as relates to the personal net worth and have them more dependent upon marketable securities, both qualified and non-qualified. And then long-term is what is the growth of the net worth and how do we proactively plan for the estate? Because many states have inheritance taxes. I know, by example, Oregon or Washington tax liabilities or tax rates between 16 to 20%, in addition to the federal tax rate, which is right now at 40%, and that could even go higher. So depending on the person's net worth, the estate taxes can be very meaningfully long-term. So what are the final outcomes? What do we gain for all this planning? So let me try to summarize and pull this all together. So from that, we then worked closely with the CPA, the attorney, the financial advisor, the business consultant on some business strategies, and also some leadership development in coaching. And then we were very instrumental in working with the family on some of the family governance issues, their roles, responsibilities, and also modifying and upgrading the board. So we took a very integrated approach towards this strategy. Number two is the growth. We were we were able to define the cash flow required to fund that transition and making sure we're keeping our eye on that ball. And to manage shareholder expectations, we defined a specific distribution policy that the board voted on and ratified annually to keep the company financially sound while still maintaining the debt service to mom and dad. And then what we finally did, we did a stress test and sensitivity analysis to try to anticipate at what point if the business does have a down cycle or a downturn, what does it mean in terms of the ability to complete and fund our transaction as been outlined.
Don, as you wrap up here, I think sorry for interrupting, but I think it's applicable to that slide. Great question here is, what is the typical transition plan? What is the timeline for all of this that you've done?
Yeah, probably becomes apparent when you look at this. There's a lot of pieces to this puzzle. So first, what we do is the first step is probably about 30 days to really get a firm handle on the current situation, the goals and objectives, and then go through the analysis and the identification of planning strategies. Subsequent to that is making decisions based on the information, getting input from various advisors along the lines. So I would say the average time frame is roughly between 6 and 12 months. I have some cases, depending on the complexity, that after we've executed the initial strategy, then it's been ongoing for about 5 years, a number of those. But majority are probably 6 to 9 months. Okay. So my advice to our attendees, just to kind of pull it all together, I believe it's very important to form your advisor team and individuals that have specialized expertise in transition succession and exit planning. So you have a succession planning expert, you might have a legal expert, an individual, making sure you get an attorney that has experience probably in business planning, but also maybe estate, an accounting organization or a CPA that has expertise, that probably has a lot of tax background, and then maybe a business advisor to help with the internal business continuity between mom and dad and the next generation. And you might even consider family counselors because roles, relationships, and if the number one reason why most family business transitions fail is because of breakdown of trust and communications, we need to pay attention to that. Secondly is making sure that you do have your well-defined set of objectives, because obviously if you don't know where you're going, you can't get there. Third is create this comprehensive personal financial plan. It needs to be integrated, reflective of all of the assets and how those assets and their characteristics are going to change through time. Next is plan and forecast the corporation situation. Corporations are dynamic. It's not a crystal ball, but it gives you the relative impact of different growth rates, profit margins, reinvestment rates, and cash flows under different scenarios. So it's important that an organization understands those dynamics. Also is create a defined transfer, and I talk about lifetime. Most planning, unfortunately, is done around the contingency, your wills and trust. The likelihood that the individual is going to live, and at some point in time, they're going to have to change their relationship with the business. So it needs to be a lifetime strategy. Plan around the likelihood. Second to last, implement your decisions in an integrated manner. It can't be done in a vacuum. It can't be done in segments. It's important that we understand the interrelationships between all of these planning elements. Then finally, as I mentioned before, considering the dynamic nature of this kind of planning in families and businesses, monitor that plan and update it accordingly. So that pulls it all together. Love to hear any other questions, maybe the next slide. And I really appreciate your time today and the opportunity to kind of share my thoughts. Derek or Mark?
I do appreciate your time, Don, as always. And as we wrap up here, everyone, again, the chat window, if you move your mouse over the bottom of the screen, should pop up. You can click it, and your chats will come directly to me. Amy has asked, with A-type personalities running a lot of these businesses, how do you convince them to bring in other teammates, if you will?
Yeah, great question. Typically, what drives an A-type personality is the desire for control, in my experience. So I think it's important that because any transition, most transitions are delayed because of the perceived impact on an individual's identity or their kind of emotional connection to the business. So I think it's important to bring that to the forefront of the conversations early and help the individual understand that your identity and your emotional connections from the business don't need to be negatively impacted. You don't need to be extricated from the business to make this happen. And important to understand that there are opportunities, and then bring into the picture the different objectives and the competing nature of those objectives, and really start to ask some hard questions about their future, how they can take advantage of what they've worked so hard to create, and help them understand that being proactive is going to be a lot more efficient and a lot more effective to both them, the business, and their family if they get ahead of this game.
Well said, Don. Let me scroll here for any last questions. Give me a sec. Got one last one here. Looks like from Kevin. It says, can you begin the process too early? When is the right time to start?
Well, yeah, I think you can. You know, for example, if an individual, let's say I'm dealing with right now this construction design company, they're in their mid-40s. So what they're wondering is, what should I do with this business? Should I sell it to my key employees? They have a number of key employees involved already right now. Or should I plan to sell this externally? So what we have done initially is define the financial security requirement, but then also help them understand each option and the trade-off of each option. So if an individual isn't sure what they want to do with this business long term, and there's a number of things that need to occur for them to make that decision, then they need to wait for those, for that information to become available. But on the other hand, there isn't almost too early to this equation, because it's almost like I'm planning for your retirement. You don't start planning for your retirement when you're 60. You start planning for your retirement when you're 20. So.
Well said, Don. I run across that one quite often. The earlier and the more you prepare, the earlier and better retirement you can have. So same with business planning. Start with the end in mind.
Yep, absolutely. And it's a vision. An individual has to sit back and say, because one other final concept along those lines is that I find that individuals are very reluctant to change their position. The reason why, because they don't know where they're going. So what's important to do is define, you can't know where you're going. You can't get there until you know where you're going. So the struggle is they have so much invested in their current state, in their current position. They have to visualize what the post-transition looks like. So I'll spend a lot of time helping them to define what this post-transition life looks like. How do you want to spend your time? How do you maintain relationships with the individuals that you're close to? How do you continue your identity, and how do you continue to add value to what you do? How do you continue to get up in the morning and feel good about what you do? And then they begin to define, because it's not going to be golf every day, because that's going to last about 3 months. But they're entrepreneurial in nature, and they want to maybe even start a new business. They might want to go on boards. They might want to find some way to apply their knowledge and wisdom and experience to helping other people. So it might be charitable, maybe philanthropic, it may be coaching, it may be mentoring, it may be consulting. So there's a whole host of options. So there is life after business.
Well, folks, I wanted to thank both Donald and Derek for being here. What an interesting presentation. We hope to have you back again to talk some more about this very complicated process. Even it is complicated. It's a big project, but that's, why you bring in professionals. So it sounds like. Well, on behalf of Advice Chaser, we want to thank the organizations that have worked with us to bring you this webinar today. To our attendees, go ahead and look to your email for a link to the replay of this event, and you're welcome to share that with friends, family, or coworkers. Here at Advice Chaser, we're all about helping you find the financial advisor who is a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners is committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com, clicking on the link to find an advisor. Once again, for Advice Chaser, thank you so much for coming, and we hope to see you at another webinar soon.
Thank
Goodbye,
you all.
everyone.
Appreciate it.